Welcome back to Wealthy Business, your go-to channel for finance, global economic trends, and personal growth insights. Today we're diving into a major financial shift that could shape the future of Europe's economy. The European Central Bank is on the brink of cutting interest rates. Markets are nearly certain about it. As of the latest data, there's a 99% chance the ECB will reduce its key rate by 25 basis points. That would bring the deposit facility rate down to 2%, half of its mid-2023 peak of 4%. But what does this move mean for you, for businesses, and for the broader economy? Let's break it down. Why is the ECB cutting rates now? The ECB's primary job is to keep inflation close to 2%, and right now it's pretty much there. Preliminary data from May shows Eurozone consumer prices rose just 1.9%. However, economic growth remains sluggish. The euro area's GDP only grew by 0.3% in the first quarter of 2025. Combine that with external uncertainties like Donald Trump's new tariffs on European steel and Chinese exports, Germany's changing fiscal policy, and the EU's ambitious rearmament agenda, and you get a complex puzzle that the ECB must navigate carefully. This rate cut, then, is both a sign of confidence in falling inflation and a tool to stimulate an economy that's just not growing fast enough. What comes next? Will rates fall further? Many analysts believe more cuts are coming. Some think we could see another reduction as early as July. But others say the ECB might pause during summer and resume cuts in the fall. Barclays is forecasting 2 more 25 basis point cuts in September and December, which would bring the deposit rate well below 2% by year-end. That said, the ECB is being intentionally vague. Their meeting-by-meeting strategy allows for flexibility in case inflation suddenly surges or the global situation shifts, particularly with the risk of retaliatory tariffs and ongoing geopolitical tensions. Bank of America analysts even noted that the ECB is running out of reasons not to go below 2%, but don't expect them to say exactly how low they're willing to go. How will this affect consumers? This is where things get real. Rate cuts affect both borrowing and savings. If you have a savings account, you might see a lower return. That's because commercial banks earn less interest on their deposits with the central bank, and they often pass that cut on to savers. But if you're a borrower, especially with a short-term or variable rate loan, you could benefit. Mortgage rates, personal loan rates, and credit card interest could all decline. However, fixed-rate products like a 10-year mortgage are less sensitive to this kind of policy change. Bas van Geffen of Rabo Research notes that long-term rates often reflect not just current policies, but also market expectations. And since this rate cut has been anticipated for months, much of it might already be priced in. Still, if the ECB signals further cuts are coming, we might see additional downward pressure on borrowing costs. Bigger picture, global implications. The ECB's move also ties into bigger global trends. Trump's tariff agenda is already impacting Chinese factory output, as shown by the sharp drop in their May PMI to 48.3. That suggests weakening global demand, especially from the US, which could ripple across Europe. Meanwhile, Trump's newly announced 50% steel tariff is likely to raise US prices and may trigger an EU response. Add to that the uncertainty surrounding the EU's rearmament investments and Germany's fiscal pivot, and it's clear the ECB will need to stay nimble. So this week's rate cut isn't the end, it's just the beginning of a complex monetary dance. Final thoughts. The ECB's expected rate cut marks a significant turn in European monetary policy. For consumers, it could mean lower borrowing costs, but also smaller returns on savings. For investors and businesses, it's a sign that the central bank is willing to act, but not overcommit, in a highly uncertain global environment. Stay tuned, because how the ECB responds to inflation, growth stagnation, and geopolitical pressures will shape the economic future of Europe, and perhaps the world, for years to come. If you found this breakdown helpful, don't forget to hit the like button, subscribe to Wealthy Business, and ring the bell so you never miss an update. Drop your thoughts and questions in the comments. We love hearing from you. Until next time, stay smart, stay informed, and stay wealthy.